Good evening, everyone. On behalf of Team Edelweiss Mutual Fund and all of us, wish you a very, very happy Friday and welcome to yet an episode of Edelweiss Connect. It's been some time since we've met, and hope that wherever you're watching in from or listening in for, you and your families are safe and sound and happy in these constantly interesting times. This is a Friday. It's a good Friday to talk equities. The Sensex just became a senior citizen, and I am told sustained being a senior citizen, hit the 60K mark. So it's a good time to talk about all things equities today. What the future holds. There's so many opinions going around. So we thought, why not have some conversations on equities this Friday. For that conversation to move forward, I'm in conversation with two wonderful gentlemen. One is a familiar face, of course. Harshan is a face that all our IFA friends and partners have interacted with. And Trideep joins us. Many of you may have heard the news announcement or heard from your own sales team as co-CIO. I think as of today, he's about a week old. He joins us to augment the equity team as fund sizes are growing thanks to all your contributions and efforts. It's also important that we make an investment in our investment teams, and this move is towards strengthening that. So today I'm in conversation with Harshad and Trideep. Format for this event, I think many of you have come to Konnect, so you know the format, but I have a bunch of questions that I will throw on behalf of our IFA partners to Harshad and Trideep, both on India, the world, macros, earnings, anything that I can think of. We'll also then take questions after about 35-40 minutes. And it'll be awesome if you start sending in your questions to us through the platform right now, and then we'll keep taking questions. So that's broadly the form. So Harshad, I want to start, the first question with you. And I want to hark back to a time in November 20. And, unfortunately, the way times are, we have rather short-term and thoda gajini-oriented memories these days. So March 2020 seems like a long time away. But let's just go back to November 2020. I remember you had given a very clear view then. And back then it was a bold view. I don't know if it looks bold now, but it was a very clear view on why it is risky to be underweight equities. And there was a note that we had put out. Of course, since then, the market has done what it has done. It has taken many, many investors by surprise in doing so. How do you see this period and what is driving equity markets? Rakesh Jhunjhunwala on TV came and gave the folks at CNBC a very hard time for attributing it to liquidity only. But what do you think is driving equity markets?
Sure. Thanks, Radhika. Hi, good evening, ladies and gentlemen. It's a pleasure to be back talking to you. What I'm going to do to answer Radhika's question is spend a few minutes on a framework that we use to understand stock prices and markets. Radhika, what you mentioned, implicitly, many people, maybe they will not express it, but implicitly many people seem to believe, particularly in recent times, that the markets are being driven primarily by liquidity. And therefore, because of valuations rising and not so much backed by earnings growth. That is a predominant view. I will not say it's a consensus, but predominant view, and which is what leads to skepticism as to is this likely to continue, right? So I'm going to use a couple of slides and give me a few minutes to explain. Manisha, can we go to the next one, please? Yeah, so this is a fascinating chart. And I do remember when I look at this, the period of global financial crisis, Lehman collapse. I will very briefly explain. I hope it is visible properly. We have removed the complications. The dark black line is the Nifty, and the period we have chosen is from the beginning of 2020, so that it captures the fall in the markets and subsequent revival. So the dark black line is Nifty. The blue line is the 1 year forward EPS of Nifty at that point in time. Remember, it's 1 year forward EPS. And the red line is in a way a resultant of that, which is the price to earning ratio on a 1 year forward basis. And I will explain the story as to what happened in those fateful months. It's really fascinating. Just a caveat that I have simplified this. Normally in terms of sources of return, there are two other components which I'm ignoring here because we are talking to the Indian audience. Currency is not relevant. And I have also removed dividend because in the bigger picture, a dividend actually in this story doesn't really count that much. If you look at this chart, you will remember those days of end of February to third week of March, how Nifty collapsed. And that's very evident in the way the black line has fallen. However, it will be interesting to see what was happening to the red line that time, which was the 1 year forward EPS forecast. So well into the collapse that lasted for about 3 to 4 weeks, the earnings actually were rising in terms of 1 year forward. And the earnings that I'm referring to here, I like to call them earnings progression because it has two components. One is the earnings growth that happens with passage of time. And the second is upgrades and downgrades that analysts do to the earnings. So it's a combination of that. So well after the market had fallen, the earnings were still holding steady. If you recall, in a lighter vein, I can say this, that when the crisis happened, when it struck us, essentially the analyst community was like a herd of deers caught in the headlight, right? They didn't know what to do because it was an unprecedented crisis. They didn't know how it was going to play out. You will notice that the market bottomed out on March 23rd, if I'm not mistaken, 2020, but the earnings bottomed out only in the first week of July, 2020. So that's a fascinating story. It was exactly the same way it played out in global financial crisis. So when we try to understand as to what was happening, and Radhika, you did refer to our November 2020 communication, and we were very bold in that. But I also recall that we had a call in April. Niranjan tells me that we held it in April 2020 after the market had fallen. And if I hope the audience remembers it. The only recommendation we gave that time is don't redeem. Because this was an unprecedented event. It has caused markets to fall a lot. And we don't think that the cash flows are going to be impacted forever. That's what the market seemed to believe. So I hope people also remember our call of don't redeem. Obviously, as an industry, they didn't listen to us. And subsequently, for 9 months, we had redemptions in the market. But, luckily for us, the call played out. Manisha, can we go to the next slide? Now, I'm going to directly give you some numbers to see how much of the market returns are being driven by valuations and how much are being driven by earnings. So if you look at, I've chosen 3-4 lines. So firstly, let's look at on a 12-month basis what has happened. So 12-month basis, Nifty is up 57%, of which 38.6 of 57.3 can be explained by earnings growth. So almost 2/3 of it can be explained by earnings growth. Remember, this relationship between price, earnings, valuations is multiplicative in nature, not additive. So if you try to calculate back, just addition won't help. You have to do the multiplicative relationship. If you look at from 1st Jan 2020, that is before the murmurs of this crisis came, what happened? So 44% return in Nifty since then, of which 17 points. So roughly 40% came from earnings, 60% came from valuation re-rating. Now let's look at 23rd March 2020, which was the day when the market bottomed out. Of course, we have a benefit of hindsight here. From then, the market is up 130%, right? And of which almost 90% can be explained by valuation. And that is exactly what, Radhika, when you were saying that people have this doubt in their mind as to whether it is being completely driven by valuation re-rating. However, we looked at the previous chart and you will notice that the earnings at that point of time were the wrong earnings. Those earnings were not cut by the analysts because, as I said, analysts were completely zapped with what had happened. If you look at 5th July, which is when the earnings actually bottomed out, you will notice that almost 48% of 65%, a healthy 60-65% of the returns can be explained by earnings growth. So in conclusion, the answer to your question, Radhika, that markets are being driven by a healthy mix of earnings progression and valuation re-rating.
Thanks, Harsha. Then, I want to kind of build on this question and come to Trideep and talk about another trend that has, been very fascinating in the last year, and that is the change in the kind of companies that are coupling to public markets. I always joke that India grew up on a diet of what you call consistent compounders, and there were companies like Page and Pidlite, and they had a steady ROE, and they were quality companies, and we understood these business models. Now suddenly you have very, very different kind of companies listing, and of course they cause, and I'm not talking about any specific name, they cause a lot of debate. Now Pradeep, you are someone who spent a considerable amount of time investing outside India, in emerging markets. You've seen many different investing approaches and many different business models. So the question to you is that how has investing evolved over all these years, from everything from cigar butt approaches to investing to companies that are yet to clock profits but may have 30-40% market share? The developed world has seen these companies, but this is new to India. Sudeep, you're on mute. Yeah.
I was saying good evening, everyone. Thanks, Radhika, for for this question and for this chat. And I think as a student of investing over the last 3 decades, as I've spent in emerging markets, developed markets, I've seen investing evolve in very different manners. And I was thinking as to how to put an answer to this question, which is true to the label, in the sense to the question you asked, but at the same time give the audience a bit of a bird's eye view with regards to how investing has evolved. And the way I come about is not perfect, but if I can, request audience to be with me, I don't have slides, to be with me for the next 3-4 minutes. I'll take you through the journey of investing across 3 dimensions. And I sort of talk about markets, mispricing, and business models. And at the end of it, Radhika, you will have the answer to your question. So I would say, at the end of the day, investing is basically a hunt for alpha creation. And every investor, whether it's based in India or globally, it looks to do the same. And if you look at over the last 100 years, when Jeremy Grantham was active, to basically now, when Warren Buffett is in his 90s, the source of alpha first started with global markets when Walmart turned out to be a newly listed stock, by the way, as expensive as D-Mart in India at that time, and over a period of 30-40 years went on to become the global retailers. But since then, the growth rates have kind of faded. So the source of alpha has moved from, on the markets dimension, has moved from global markets or developed markets to what we used to call something as emerging markets, where companies like India or BRICS and countries like that actually fall in. That was the second evolution of source of alpha creation from an investing standpoint. From there on, it moved on to what we call as frontier markets, which were further underexplored. And ultimately, the hunt of alpha is what drove investors to these countries from an investing standpoint, so that they can get outsized returns. And so that's one dimension of the hunt of alpha creation, which is the markets from global to emerging to frontier markets. At the moment, India is, I would put, somewhere between emerging and developed, where a certain set of stocks are there or thereabouts, and there are a whole bunch of companies which are particularly in the mid and small cap area, which are relatively underexplored, under-researched, and whatnot. So that's the first dimension. Second is the mispricing dimension. Now, as books on investing were written, starting from what from what Ben Graham wrote to what Jeremy Grantham writes, and to Howard Marks and stuff like that, to put a time series around that, I'm sure audience would note that first we used to get companies which were trading at a fraction of their working capital. Sitting today, thinking about those times makes you nostalgic and feel how investors at that time, how easy was it for investors at that time. But I would say those were the days around about 1920s, 1930s, 1940s, when balance sheets were difficult to get. And the P&L and balance sheet and cash flow, as we already know, at that time was not very easy to pinpoint, and hence analysis was difficult. So from there on, as Radhika mentioned, basically Page Industries and a few other companies, which were cash flow machines, came about, and the extent of mispricing moved on slightly further out in our forecast horizon, where we looked at discounting the future cash flows further ahead to create alpha for ourselves. And from there on, today we are sitting in a situation where the starting point is that the company is making losses. And if I were to sort of elaborate this point a little bit further, I would say, let's say a company makes about 100 rupees of sales. And for it to do that, it generates 80 rupees or it needs 80 rupees of cost. So it makes a profit of 20 rupees. And for that to happen, it needs a capital of 50 rupees. Now, if I were to make the capital assumption a little loose, i.e. more capital is available, then the company can invest more and would say that I would grow more, incur losses in the short term, but over a period of time, courtesy the strength of the business model, I'll be able to return to profitability. So that's where investing is at today, where business models like that of Zomato, like that of Swiggy, like that of Uber are coming up for analysis, where the investments are made upfront in the hope that they get market share, which can't be replaced over a period of time in future. And when I say future, I mean 5 or 10 years. And then, and hence the cash flows will happen over a period of time. Is this completely new? The answer is no. Amazon has proved globally that, when Amazon got listed, I remember there was a Goldman report, which the title of which was to be or not to be. And there was enough doubts whether Amazon would survive or not. Today, 20 years later, we don't ask that question. Some of these business models which are currently incurring losses would turn out to be businesses like them. And for us to put a finger on which one of them, we have to again take further step out with regards to our investing knowledge, which has to migrate from just looking at the financial statements to basically understanding cash flows, to basically kind of finally where we are today, forecasting how the business would look like in 10 years' time, which is no easy task by any means. But having said that, that's where the hunt of alpha creation brings us to identify the big mispricing and and bring it forward. The third, so that's the mispricing angle evolution of investing. The third sort of dimension I would point to is the business models. If you look at the business models that were there in 20s, 30s, 40s, or all the way through 60s, they were capital heavy industries where the plant would be set up, they would derive sales, and from there comes the profits. And we would analyze the capex, we would have the luxury of doing that, and then over a period of time, analyze returns. From there on, we have moved on to business models which are more intangible driven, where they don't need too much capex. Some of them don't even probably need to list, apart from branding related considerations. So, earlier, while investors had the leeway of looking at the capex, and that gave them a bird's eye view of how things may look like 3 or 4 years' time. Here, you don't have that insight as well. So bringing all of these complexity into analysis in the form of business models is the third dimension how investing has evolved. So now, having seen the investing journey through the markets, the element of mispricing and different type of business models that have evolved, to answer your question, Radhika, I would probably say that, with historical financial analysts who would be strong MBA grads, who would kind of be, whose strong point would be understanding finance. We need to put a different lens on and get business experts to value these companies and bring that insight into our valuation framework for us to derive alpha in coming times. And I think that's the direction where investing will probably evolve, in my view, over the next 5 to 10 years. We have some evidence of that already happening in private equity markets. I think you will see that more and more happening more and more in listed markets. So a rather verbose and long answer to your question. It doesn't have one answer, but hope to the listeners that provides a bit of framework and a bit of thought points which they can build on.
No, it's actually a very interesting framework and also a good perspective through history. The Walmart example struck me. Harshan, Trideep talked about financials and sort of new parameters, let me come to you with a very direct and contentious question, and probably the most debated one. Is that in these markets, the most obvious question outside of market ka kya lagta hai is valuations are rising. And I know one of the perspectives you've always had on valuations, even when it comes to large cap versus mid cap, etc., is that looking at index level valuations in itself is fundamentally a problem. So, how do you read valuation numbers today, and what would you advise the IFA partners who are listening? What framework should they apply to look at valuations?
Sure. Manisha, can we go to the next slide, please? So, valuations, as people often say, it's like beauty is in the eye of the beholder. It's basically an opinion of all the market participants together, right? That's what valuation is about. Just as earnings forecast is an opinion of analysts covering a particular stock. So valuation has to be understood in this way. Whenever I'm asked, and in every interaction that I have with clients, I'm asked this question about valuation. Valuation is high, therefore should we sell? Or valuation is low, therefore should we buy? One learning that I have had in my career, both on the sell side and buy side, frankly, my appreciation for that improved when I joined buy side, is that valuation is never, ever a reason to buy anything or sell anything. I will just give two examples before coming to the question of market as a whole, which will be, which I think everybody will immediately appreciate. If you look at consumer stocks in India, let's take an example of paint stocks in India. Without an exception, almost, they have never really traded at so-called, within inverted commas, cheap valuations. If you were focused only on valuations, you would have sold some of these paint stocks 5, 10, 15, 20 years ago. But just look at, how much, what kind of returns they have provided. On the other end of the spectrum, look at PSU banking stocks. They have never appeared expensive. They were always cheap on a price to book basis, etc., etc. But look at the kind of, apart from, times of strong rally in them, over long periods of time, they have not really generated a lot of wealth. So valuation is never in isolation a reason to buy anything or sell anything. In the context of market as a whole, and the chart that is appearing on the upper chart is about the price to earning ratio on a 1 year forward basis. And we have purposely given all the way from March 06 so that it covers part of the last big upcycle in earnings that we saw. And on the bottom chart, we have given the return on equity for Nifty companies. So whenever you are thinking about the market as a whole, you should ask yourself, when you look at valuations, where are we in the business cycle? That is a very, very important issue if you historically also look at it. Now, if you look at the bottom chart, you will notice that the return on equity for Nifty companies, and I'm using Nifty as an example because frankly, that's something that is widely available. Unfortunately, the similar thing is not available for a mid-cap and small-cap universe on a 1 year forward basis because of lack of coverage and history. But you will notice that the return on equity for big Indian companies, which was in excess of 20% towards the fag end of the last big upcycle in earnings, basically trended down, and bottomed out somewhere around 11.5%. So it halved over a period of more than a decade. Of course, there was a small uptick after global financial crisis when the earnings growth picked up. So this is where we are. And if you look at the recent history, you will notice that it has bottomed out and starting to trend up. And the trend up actually started even before COVID struck us. Unfortunately, COVID led to some kind of a problem. But as we know, the shrinkage in real GDP did not deter Nifty from posting a mid-teen kind of earnings growth, which remains a surprise for many people. So essentially what I'm trying to say is that if you look at the current valuations, of course, by no stretch of imagination, you can call them no-brainer. They are expensive. They are higher than the long-term trading average. But if you look at the fact that we are in the beginning of an upcycle, I don't think at this stage of the cycle, the valuations are excessive. Manisha, can we go to the next slide just to complete the point? The next slide, if you see that, basically talks about the earnings growth for Nifty companies over long periods of time. I was referring to the period from 02 to 08, where EPS growth was 24% compounded in that period. But after that, it has been rather lackluster. It's only now, over the next few years, starting from, let's say, FY21, that we expect a meaningful acceleration in earnings growth. So therefore, when you think about market valuations, when CNBC or Economic Times tells you that a market is trading at higher than the average, just remind yourself that you are in the beginning of an upcycle, and that is the context that you should always use.
Thanks, Harshad, and we can sort of take off the slides as we switch gears. So just switching gears from markets and valuations a little bit, Trideep, I want to come to you with two questions. The first one is, of course, I know a topic that is very close to your heart, and that is the evolution of brands. Most large brands that we see in our day-to-day lives are from the developed world. But gradually you are seeing the growth of homegrown Indian brands, some of which are listed businesses, are making their way to listed businesses. How do you see this evolving, and how do you see India sort of having its fair share and giving birth to large global brands and global businesses? We actually saw an Indian company, by the way, list on NASDAQ. That's not a branded consumer company. But how do you see this evolving?
Yeah, thanks, Radhika, for this question. But to answer this question, I'm going to turn the table a little bit. So let's take a global brand, for example, Louis Vuitton. And if I were to ask you, what do you think Louis Vuitton as a company, LVMH is the parent company behind it, started as? What was Louis Vuitton? What did they make? What was their first product?
I assume it would be handbags or champagne, because those are the only two things I know. And I assume that if this answer is right, you will gift me both champagne and handbags.
Thanks for saving me for some major expense item. So I would say that, you would be surprised, and the audience would be surprised, that Louis Vuitton started as making suitcases. You can go and search, on the Google, and you will say they actually, Louis Vuitton, the gentleman by the name Louis Vuitton, actually made suitcases which are very durable, and these are the times when people used to sail on ships, and hence durability of suitcases is very important. But over a period of 100+ years, the brand has evolved to make really good handbags and other pouches as well, which attract global attention and exhibit significant amount of pricing power. The point I wanted to bring out in that is basically how long does it take to create a brand? So what started off earlier as a suitcase company is today well known as basically one handbag company. So it takes there's academic study to that effect, but broadly it takes about 30 years to create a brand, 30 years to basically take it to the next level. And then the third level becomes, depending on the enthusiasm of the person running it, whether they take it forward or then go down with it, one of these two. So now, if you put that in the time scale where India is, I would say India is really early in this context. And if you think about it from Maslow's need standpoint, from basic roti, kapra, and makan, we are just about getting more aspirational when our per capita GDP has just crossed 1,000, 1,200 or thereabouts. From here on, we have the journey where individuals look to make a style statement. And that's the situation, or that's the position from where Indian companies will actually start to become global. That's what we saw in most countries like Korea, Taiwan, or even the United States happen. So if I were to sort of give you that background, and then say that, that having seen the global companies evolve into becoming meaningful brands, companies like Titan, companies like Asian Paints, companies like Maruti, and even Larsen & Toubro, companies from different actually kind of line of business, have a strong chance of making it on the global platform, brands to reckon with. So far, the companies which may not be consumer companies, but who have made a global mark for ourselves as a country, are basically IT services companies. These are more services-oriented companies from that standpoint. But the reason why they have been able to do so because of their global ability to sort of to make out or to ability to do services which are of global standards. I think as India evolves in terms of style statements and being more aspirational, some of the companies that I mentioned have a strong possibility of becoming global brands over a period of time. So in other words, while we can get bogged down with near-term valuations and whatnot, and I mentioned about Walmart as an example. When Walmart got listed, in the first year, its valuation was 75 times. And subsequently, it had a compounded earnings CAGR of about 25% for the next 30 years. So when you evaluate DMart and think about what is expensive, what is not, and to put some context around how things have happened around the globe, has a lot of insights. And hence, in that context, to become a brand, some of these companies have a strong chance of turning out to be global brands over a period of time. Of course, it needs consistent evolution. It needs consistent evolution to evolve with the consumer, with the end customer. And we are taking that for granted. That can't be taken for granted. We have to evaluate on an ongoing basis. But those 4 or 5 companies have a strong chance of making the mark. That's what I would say, Radhika.
My second question, and since you mentioned, some of the names that you did, is that quality investing, quality has been an important part of investing in India. Standing today, how do you assess quality when you look at companies? What are the 3-4 parameters beyond the standard stuff and return on equity that everyone is talking about? But how do you assess quality in the context of today?
I think in the context of quality actually boils down to 2 things, really. One is the management, which is driving the company. To what extent are they oriented towards making it big? What are their aspirations? Where do they sort of want to take it forward from how important is corporate governance as part of their framework? And management intention in terms of how big do they want to get. So, for instance, when I met Narayan Murthy, and this I'm talking about 2002, 2003. The only thing that I would say, someday I would like to list on NASDAQ. And in one way, that was the first company to get listed in there. So that tells you about the global ambition or the ambition of the company. And the management intent was that I would be the company with the strongest corporate governance, the best annual report. And I remember around those times, Infosys used to have the best annual report. So, these are some of the characteristics which are the people who get together to start the business, which is the management, what ambitions they come with, what they plan to, how they want to achieve it. The process is the number 1 part. And number 2 is basically execution. Whether it's cash flows, whether it's cash flow generation, whether it's, you mentioned some of the rudimentary metrics like, we call it rudimentary, but one of the most important metrics are return on capital employed, return on equity. But more importantly, on a day-on-day basis, on a unit economics, does the company kind of, really stand out with regards to being a profitable company from an investor standpoint? That would be the second aspect of quality. The reason I say this is because a lot of companies appear to be profitable because they have a lot of leverage going behind it. And hence unit economics and understanding that and how they approach the business becomes interesting from an evaluation standpoint. So that would be my second pointer towards looking for a quality business as to the management's understanding and evaluation of the unit economics at what they do. And the third would be basically, seeing them over a period of time in terms of consistent execution. I think we underestimate doing the same work in the right way, day-on-day basis. Those would be the 3 things, apart from the return ratios and the cash flows, which we look at, the so-called soft factors, including probably kind of these days ESG, etc., would be a few things that I would look for if I were to look for quality within the company, particularly in the mid-cap and small-cap space as companies are still evolving.
Thanks, Trideep. Harshan, I want to come back to a point you made on cycles and where we are in cycles and the fact that you will see good earnings growth going forward. And the question to you is really, which sides of the economy and sectors do you think are likely to lead this growth compared to where we have seen growth over the last couple of years?
Okay. So, our worldview is that we believe that the Indian economy bottomed out last year and trending up. A lot of the heavy lifting in terms of supply side reforms that this government has done over the last 6.5, 7 years, I think they will start to pay off. Unfortunately, the payoff of that got delayed because of some India specific factors that happened over the last few years. So that's our worldview, that Indian economy is going to accelerate, which is going to translate into growth for the economy and the earnings. So if you look at our portfolios, I would like to give that answer in the context of the portfolios, that we are overweight on sectors, businesses, which are more levered to the economic growth. So if you look at our portfolios, industrials is a big theme in our portfolios. So industrials, of course, comes into construction businesses, industrial products, capital goods, and so on. We do believe, and this is a slightly controversial statement, or many people will object to that based on CMI data, but we do believe that the private capex is something that you are going to see in a big way. The reason why it's not captured, it's going to be very, very different compared to the previous cycle. So for example, it's obvious that thermal power capacity is not going to get added, but there are newer areas that are emerging, and our portfolios, we believe, are geared to benefit from that. So private capex is something that we do expect to start happening over the next few quarters. We are also very positive in terms of portfolios, and we took this call last year in real estate. So these are some of the sectors: real estate, cement, industrials, where we believe that we are positive on. And of course, we have to fund, everything has to add up to 100. So on a relative basis, we are relatively underweight on some of the defensive sectors.
Terrific. Thanks, Harshad. Trideep, I want to come to another trend that has been very popular and a lot of IFA partners have participated. One of the things that has become very popular is investing opportunities in global markets. Many Indian investors are now realizing the need to diversify globally. How do you see this, as someone in the investment profession? And what do you think are the kind of businesses that we get there that we don't get in India?
Yeah, I think this is part of as Indian investor evolves from gold to real estate to equity markets to Indian equity markets, and now going global. That's the next step. And in my opinion, over the next 5 to 10 years, global investing would add another layer of alpha creation for investors who are ultimately looking to sort of use equity markets for wealth creation standpoint. And of course, the merits of global investing were very clearly to diversify away the current country risk. But secondly, it also creates a bit of currency diversification, which is more than what people anticipate, because at the end of the day, some of the developed market currencies, if the Indian currency, if you look at it, depreciates at the rate of roughly 4 to 5% per annum, but the underlying currency of the asset that you're owning doesn't depreciate or remains stable or appreciates versus that of the Indian currency, it brings a bit of currency appreciation as well, but currency diversification as well. But those two apart, today Indians are very well traveled and want to get exposures to business models which are not there in India, or they are very unique. So I'll give you some examples. For instance, pure EV plays like Tesla, etc., are still not available in India. Wagon, or whichever way you pronounce it, food retailers like Whole Foods, etc., are an area where India has to still evolve to, and it's a strong area. We are seeing, how Nykaa is turning out to be a popular, which is a fashion retailer, and fashion retailers have been, there are quite a few which are listed abroad. It is just about kind of opening up in India. Similarly, at some point, vegan food retailers would be an important part to invest in. Currently, there's nothing available in India. Obviously, the Airbnb players, OTT players are another ones which are not available. But these are the common names which most people associate. Most people talk about. I wanted you to also know that there are certain unique business models which probably, can only happen in one way or the other. Like, for instance, I'll name a company called Taiwan Semiconductors. It's called TSMC. Of the level of consolidation that the sector has gone through, I'm not sure whether, never say never, but whether we will ever have a company of that magnitude where, any other company across the world can get access to, or any other investor in the world can get access to. So that's one. Second, I would bring to your notice a company called Shimano. Anybody who's into fitness, who's into bicycles would know Shimano is a global leader in bicycles. But, and they make tremendous amount of profitability. This side is a phenomenal franchise brand to own. But again, I'm not sure whether you'll get a second company of that nature. The third example I would give is a company called Kaynes, which is a Japanese company. They are a leader with regards to factory automation, far better than the ones that we are used to in India, like ABB or Siemens and whatnot. And if you do some search, you will kind of realize what I'm talking about. They are miles ahead in terms of robotics and whatnot. So for an Indian investor who is increasingly well-traveled, who has seen or who has tasted some of these business models abroad, the only way, and he's based in India, for them to kind of, and who have obviously the money to invest, to get access to the global funds that I think Edelweiss offers. And I think there's meaningful room to innovate, not just in the Indian market. There's a meaningful room to kind of, expand going forward. And those would be some examples where, as I said, are the ones where, where Indians who have rupee kind of denominated earnings can get their, can add another leg of alpha creation to their kitty.
So Trideep and Arshad, I'll ask you one more question each, and then maybe ask the audience also to put in any questions they have. I have a couple of questions that have come in from the audience. Harshad, I just wanted to come back to a point around mid and small caps. I know that you've been talking about mid and small caps and how they are an opportunity over the last 1 year, and that has played out well compared to a time where large cap drove the rally. I remember we had done this call last year and sort of talked about ignoring past underperformance in the mid and small cap space. Sitting today, what do you think is the way forward for the mid and small cap segment?
So you're right that we have traveled some distance in terms of outperformance of mid caps versus large caps. And the background to that was clearly 2018, 2019 that you alluded to. Those were the 2 years combined. If you see at the index level, mid caps underperformed large caps by almost 35%. So that was the backdrop. And you have seen 7% outperformance in 2020. And year to date 2021, you have seen 21% outperformance in mid cap index versus large cap index. Some of the people in the audience might remember that in the beginning of this year, we had put out a presentation, and I think we probably used it for some of these calls, where we highlighted our learnings, 13 years of running the mid cap strategy. And if you look at the historical returns, what that tells you is that over longer periods of time, mid cap tend to outperform large caps, right? So if somebody has a time horizon of next 6 months, I will say that, okay, be very, very cautious, because in absolute sense, mid caps and small caps have done very well. But somebody with a time horizon of 3 to 5 years, there is no reason to believe that why the mid caps and small caps will not outperform. Just 1 or 2 caveats here. At this stage, it is absolutely important to make sure that the underlying businesses that you own in a portfolio are of superior quality. Market bottomed last March, as we saw. From there, everything has gone up, right? Even the junk stocks have gone up, and junk stocks do go up in the second or third phase of the rally. So my only, I will urge everybody in the audience to make sure that the underlying quality of the businesses that you own in your, mid cap fund, small cap fund, or if you own any PMSs, just make sure that it is of top notch. Because at this stage of the market, corrections and volatility is to be expected. Just because we haven't got it doesn't mean that it will not happen, right? We got a glimpse of that in August, when people got really, really nervous, right? And that's reflected in the industry flows, I guess, in small cap and mid cap funds. But so corrections and volatility will happen. Every day when you wake up, please repeat this: corrections and volatility will happen. But so long as you own quality assets, quality businesses, I don't think, and you have a time horizon which is long enough, you shouldn't be worried. I will just give you one statistics which we had highlighted in that presentation. On a rolling 3-year basis, mid-cap index has, and this is the entire 20 years history, mid-cap index has outperformed large-cap index 2/3 of the time. If you look at a 5-year rolling returns, mid-cap index has outperformed large-cap index almost 80% of the times. And this comparison, mind you, is at the index level. We all know that good quality mid-cap funds have generated significant alpha over the last 10, 15, 20 years. So if you do this comparison between best quality mid-cap fund and best quality large-cap fund, the gap or the odds are even better. So the longer your time horizon, higher the chances that even from this level, you will probably end up making more money in quality mid-cap portfolio and quality small-cap portfolio as opposed to quality large-cap.
I think there's a good line there. Harshad, I remember when the small cap correction happened, and it was a pretty tiny correction, it's an 8 to 10% correction. Even then, and I'm on social media, you both are not, you saw, especially from a category of new investors, the kind of panic, that just started coming in because you haven't been used to a correction. So I think that is extremely important advice. Trideep, I want to come to you from a question that also came from the audience, and I think is a very important question. And this is on emerging markets and how you think an eventual Fed taper will impact emerging markets.
Yeah. So it's basically to kind of ask that if in a party there is ton of Kool-Aid, if the supply of Kool-Aid is taken out, how would how would things kind of come down? Will the dance party come to an end or not? There are 2 or 3 perspectives I would like to kind of quickly put in here. One is that to a certain extent, all of these assets obviously compete for attention. At the end of the day, global interest rates, where they are, I mean, if you look at it on a real basis, for the first time in over a decade, real interest rates are at a level where historically, if you go back to the history of financial markets over the last 100 years, you will see it has led to economic expansion, not just in India, not just in the United States, but also in Europe and different parts of emerging markets as well. So I would say that, globally, with significant amount of the other data point before I state the conclusion, is that, during this, in the initial days of lockdown of the COVID scenario, the central banks pumped in so much of liquidity or so much of stimulus that asset classes across the globe, whether it's emerging markets or developed markets, are flush with stimulus to come through, which will find its way through the companies or through the economy over the next 2 or 3 years. In other words, if companies want capital to expand their business, that is kind of really all over the place over the next 2 or 3 years. What that means is business expansion, whether it is in India, whether it's in emerging markets, whether even if it is in the United States, where Biden is talking about, infrastructure, enhancement over the next 3-4 years, would be a big theme going forward. In that scenario, we'll probably have a scenario, where earnings growth will probably accelerate. But at the same time, on the other side, at some point, we all know the balance sheet needs to shrink. So to a certain extent, you would find that the liquidity going away. What will happen as a result of these two is basically companies which have high ROEs, companies who have high ROICs, their intrinsic values will actually start getting impacted lesser, simply because of the spread that they have over the cost of capital. And as the cost of capital kind of goes up, typically, you will have the companies which operate at return on capital employed or return on equity closer to cost of capital start making economic losses. So those would be the share prices, those would be the companies I would be very off. In general, if I were to look at whether it's in India, emerging markets and whatnot. Coming specifically to the emerging markets angle, there are one more dollar angle to it, which is that every time the Fed or there is a dollar strength, emerging market assets come down a little bit. So I would expect that somewhere over the next 6 to 9 months, some sort of volatility to that effect will come through. Very difficult to time. US is also kind of expansion oriented. So, they would calibrate it and whatnot. But at some stage, some sort of, tightness is to be expected. But within those, I would say that this time around, fundamentally, the emerging markets are far better positioned than what we were in about 10 years ago, when we had the fragile 5 or fragile 7, so to speak, and countries went through a whole bunch of deleveraging. A lot of corporate deleveraging is already done. Countries are ready to expand. So I think you will have a good earnings scenario, something that we haven't, the world hasn't seen over the last 4 or 5 years will actually stand to happen. It's a good time to be investing. It's a good time to stay invested. And, it's a time in the market that really adds to the wealth. So I would encourage investors to stay put. And if there is a correction that happens, which I'm sure will happen over the next 9 odd months, to take advantage of the correction and get into, companies which are market leaders, companies who are market share gainers, because those are the ones which will create wealth disproportionately over the next 5 to 10 years.
So terrific. I'm going to take a couple of audience questions. One of my IFA friends is asking me if I'm subjecting everyone to rum with Radhika. I'm sparing them that, guys, today. But, since we have about 7-8 minutes, I will take a couple of audience questions for both of you. And to try and get through as many questions, maybe you can just give one-line answers, that will help. So Harshad, I think 2 questions for you. First is, what is a reasonably long time horizon for mid and small cap, since you talked about that?
I would say 3 to 5 years.
Great.
Nothing less than that.
And there was a second query from someone which is unrelated to your fund, but since you said 3 to 5 years, someone asked, what kind of time horizon should you have from recently listed IPO fund? And I would say the same thing. It holds a lot of mid and small cap. So that answer doesn't change. The second question I had for you, Harshad, is people wanted to know your views on BFSI. A long-term sort of potential on BFSI.
Sure. So long-term view, again, a very brief answer. We are positive on BFSI, but in BFSI, you have to be very, very selective. Because in financial services, the strength of the promoter, the management makes a great deal of difference. So selectivity becomes very, very important. But given that our view on the Indian economy is buoyant, that we are looking for an upcycle, there are a lot of BFSI businesses which will actually encash this opportunity.
Thanks, Harshad. Trideep, there's a question, since we talked about earnings in this conversation. Will inflation play a spoil sport in the earnings story and projected EPS?
Inflation, usually, if you go back and study, will find that inflation brings in nominal pricing power. And generally, pricing power, as long as companies can maintain through the margins, could lead to wealth creation. So I would say that be a little selective, because inflation can rummage through the financials. But for companies with pricing power, it can't be a better time to be in those companies overall. So look for pricing power as an answer to inflation.
Terrific. I see about 7 questions on China, which I will not take. I know we have a China fund, but this is a call on domestic equities. And for those who missed the session, we have a session that we did with our JP Morgan partners on the China fund that is available on our YouTube channel. It was just done yesterday, and it was done in a lot of detail. So if you do have questions on China, I would encourage you to check out that session specifically. I'll end by asking both of you the same question, and a quick question, but I think it's an important one, even though we are talking about 60K today. What is the one big risk you see in markets as we go forward?
Should I go first?
Yeah, either one. You pick.
I would say that a 3 sigma unanticipated risk would be the global terrorism with what's happening in Afghanistan. I think if that were to raise its hood across countries, we could have a geopolitical event of the order of magnitude that we haven't seen. Of course, I'm dramatizing it, but at the same time, the reason I'm dramatizing it is because that's what it's not factored in. And if that were to happen, eventually it will be a correction to buy in, but it could take the market in a tailspin, and people might get negatively surprised if that were to happen.
Terrific, Harshad.
In my opinion, the most important risk to be aware of or to be on top of is the earnings delivery by corporate India, because our bullishness about long-term bullishness about the market stems from the fact that our expectation is of strong earnings too. The reason why I'm saying is this, that if you look at last decade, there have been many false starts, that you started the year with 15% expectation only to end at 0 or 3-4%. This time around, of course, we are confident, but that is something that I will watch out as a risk.
Terrific. Thank you both so much. To the IFA partners who joined in large numbers, thank you for joining. We tried to answer as many questions as we could. If we couldn't answer anything, then please get in touch with your respective RM, and I'm sure Harshad or Trideep or any of us would be more than happy to answer any of your questions. And we'll keep doing events on different parts of our fund basket, keep bringing various series of connects to make sure that we find a way to engage with you. With that, Harshad and Trideep, thank you very much for joining today, and wishing all of you a wonderful and safe weekend. Have a great weekend, guys.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.